Welcome to the Chaim Investment Advisors Podcast. I'm Chaim Victor Schramm. I'm here with Pablo, Lasha.
Yeah, how's it going today?
And today we are talking about one of my favorite financial products to talk about lately, defined outcome products.
Yeah, I think you had sent this over to me, particularly defined outcome product. And at first, just without understanding how it's structured at all, I was just like, how is this possible? And why wouldn't everyone use this? But then, I did a little bit of a dive into it, and then we had some conversations, and I think it's really interesting, and you're pretty knowledgeable about the subject. I still have some questions, but I think it's going to be a great topic. So.
Yeah, and I mean, why wouldn't you use that product for everything? It is still one that I'm kind of thinking through with that one in particular. for some people, it probably makes sense to make big allocations to it. Some of the listeners today are probably clients of the firm and maybe even already use defined outcome ETFs because I like to recommend them sometimes. So these are things that I actually put in portfolios. It's not a totally abstract discussion. I actually have
Totally.
some experience using these on a regular basis.
Yeah, no, that's awesome. I'm excited about this.
Yeah, so we should start with just defining what a defined outcome product is.
I agree. That's what I was thinking. So my understanding, right, is at least the one you showed me. It was we're tracking a couple indexes, and we are exposed to the upside of those indexes at a cap, but we are buffered to the downside of those indexes on just one of them, actually. So I thought that was interesting, right?
Yeah.
So just we're exposed to the upside on three of those indexes, and then we're exposed to the downside on one of the indexes as a total, as a buffer. So that's as much as we could lose, which I thought was a pretty cool. I don't want to call it a trick because it's investing, so they're not they're not doing magic, But it's a very interesting piece of sci-fi.
Yeah, so you're with all defined outcome products, whether it be annuities, whether it be ETFs, whatever it is. There's really three dimensions to the product. Number one being the upside. How much are you allowed to earn with the product? Number two dimension is the downside. How much can you lose? The whole point of defined outcome products really is limiting your downside. Just that's why anybody would want one. And the third dimension is time, because all of them have time frames, because all of them use financial products underlying the defined outcome investment that are themselves bound to a timeline, be it 1 year, be it 5 years. They tend to roll over and that kind of thing, or just cease in the case of some defined outcome annuity-based products.
Yeah. I think you bring up a good point there, which is that you're using this defined outcome to limit a downside. Because obviously, I'm not looking to limit my upside.
Just really, for fun.
Exactly. To me, that's not a good trade-off. I limit my upside, but unlimited downside. Although in some cases, I'm probably in a podcast we'll do in the future when we talk about options. This is a strategy that someone might use, But again, when you're using strategies like this, we would highly suggest that you be very financially literate, you understand trading, and you have a good buffer in terms of risk to losses and exposure to losses, because you're exposing yourself to a lot of risk when you engage in strategies like that.
So. Especially with options, but defined outcome, they are conservative by nature. They are mostly, they're kind of invented for conservative investors.
So we're protecting ourselves against that, that sort of unlimited downside.
The original, the OG defined outcome product is actually an annuity. The very first ones were all annuities, and they've been around for a long time. The idea was Well, you've got people who probably are fairly conservative investors by nature. Annuities are big income based products by the nature of the products in the name. Annuities are, yeah, income driven products. So they said, like, let's get people who are already into this into something where they can participate in the market and feel like they're somewhat protected from what the market's doing. And so that was the very first defined outcome products, all in the annuity wrapper, generally speaking, until more recently. And so the idea was, I'm just going to give an example of just the complete average uh, annuity or ETF based defined outcome product. You've got
Okay.
a cap of about 11% to 12% to the upside. That's how much you can earn. And let's say you can lose a maximum of 15%. That's kind of, most of them look like that, and they're based on another product. They're derivatives by nature. So you will usually be linked to the S&P 500. So let's say you will get 12% of the S&P 500's gains, and then you're capped above that. And if it loses 30% and your capped losses are 15, you lose 15. That's kind of how most of them look at their core, and then there's a ton of variations on that theme.
Awesome. So really, I see like defined outcome is really like sort of your bread and butter, because I know you love annuities.
I know. It is really funny that I've kind of wandered into this niche over the years. Is now something I had like set out to do.
Right.
I don't know how I have managed to amass the information that I have, and really I do. It's that the idea intrigued me the very first time I heard about it from my grandmother. Actually, this is the kind of product that your grandmother might have. And it at least originally was. I was fascinated by the concept, and over the years I was on the hunt for the perfect one, because I love talking to people who make these products, because a lot of times when you really put them on the spot, they kind of step out of sales to the public mode and start talking product design mode. They kind of make this switch to like, okay, now I'm in technical expertise mode. It's really fun, but a lot of the times there are things about them that aren't so great. There's some very real criticisms of them, and I certainly have them. And so I love it when somebody can actually address those and say, well, this is how we manage that or deal with that.
Awesome. Okay, so defined outcomes, we have annuities and ETFs.
Yeah.
Which is another thing we probably should do a podcast on, some annuities sometime. But
oh yeah,
we legitimately have like we probably have like 12 podcasts.
I know.
So
we've got a lot.
Really,
we've got a lot to get through. This one though is timely because there are new defined outcome products coming out. Ones that I'm aware of, ones that I've already recommended since they've just come out, and are probably going to be recommending even more of them. Yeah.
So maybe that must have been like one of those defined outcomes you sent me, ETF. It was like is that a newer product that had come out?
That was the brand new one that Innovator ETFs came out with in October.
It was great.
Which, is a pretty interesting one. Full disclosure, I actually own. I decided, hey, I'm going to put my own money in that because I'm a big fan of it.
It's a great product, I think so.
Yeah. But, we could start also a little bit with the criticisms of defined outcome, because there's probably people saying, okay, so you're limiting the downside, you're limiting the upside. That sounds pretty good to most investors. Just right off the bat on first blush to say, do I really need a 20% every year? Probably not. I mean, the market certainly on average doesn't return that. And, I'm not looking to lose 30%. That freaks me out. I'm not a professional at this.
Yeah.
So they sound pretty attractive the first time you hear about them, and they want to know, okay, what are some big criticisms? I've got a couple. Number one criticism has got to be that, let's say the market loses a bunch of money and you're capped, you lose 15%. The next year, the market's probably going to return more than your cap.
Yeah,
it's just very likely that's going to happen.
Yes.
So let's say you lose 15, you're capped at 12, you make that 12, the market probably makes a lot more than that, probably, closer in the 20s. Yeah.
And I think not as investment advice, but if anyone just historically goes and looks at the periods where there was the most losses, it is immediately at the bottom of that trough where you see the most gains. So
yeah,
that's one of the reasons that a lot of really savvy investors will have some bonds or cash, so at that time they can profit from that. So you're right, you're eliminating the upside. Now, that was kind of going to be my number one, because there's going to be a more sort of layman way, which is that hey man, I want to make more than 12%.
Yeah. And that's my main criticism, is the series of returns, as it's called. What years you make those returns, because the stock market also, everybody says the average is 10% a year for the stock market, or maybe closer to 9. In reality, that's not made up of a bunch of years where it hits 10 or 9. It almost never hits 10 or 9. It is almost always much above or a great deal below that number.
Totally.
And so that's
100%.
One of the tricky things about creating a good product within this space. And that's why I was really a fan of Innovator's new one. I'll probably will end up talking to plenty of people who listen to this about this, because I am interested in this one. It covers a full standard deviation of the market. That's why I like it. And that was always my complaint to Innovator. I said, look, I want it to cover one standard deviation of the market, and that is 17%. And so if you're covering a full standard deviation, now you don't really need to worry as much about those years where you have a bad series of returns. You lose 15, the market makes 25, you made 12, and the next year nothing happens. You don't have to worry about that in the same way with those. And so I want, beyond the fact that there's just kind of greed involved, you want to make a lot of returns. Why wouldn't you? So everybody wants the cap high, right? They say, I don't want to be too limited. The higher the cap, the less likely it is that you're going to be adversely impacted by a bad series of returns, like I just mentioned. And that's something that I, as an asset manager, am really picky about with these things. Really low caps really bother me a lot.
And it seems like with that standard deviation, you are able to adjust. So if you take a smaller loss, that in itself is sometimes a lot of people play poker, but they say, whenever, you fold and you're losing, you're making money. You know what I'm saying? Because you're not losing the money you would otherwise, right? So, so it's a sort of similar idea there. You're able to to have, smaller losses, and maybe you can allocate some of that money next year. You don't necessarily have to be totally in that capped index, right? So I think that that seems to me to make a lot of sense. Go ahead.
I was going to say, this is one of the benefits. There are many benefits to removing defined outcome from exclusively the annuity world, even though, I'm not anti-annuity, of course.
Yeah. There's
in reality, there are benefits, but let's say that I just wanted to define out. Let's say this next year, this next 18 months, I wasn't I was concerned, like, oh, I don't know what's going to happen. Maybe I'm trying to buy a house within 2 years and make a down payment. Part of my equity is tied up in the market. I say, look, maybe I dip into the defined outcome space. Well, if you do that with an annuity and you're not 59 and a half years old, there's a tax penalty. And there's other costs associated with some annuities that you just don't want to get involved with. Having the ETF is a really low-key way to temporarily make that decision for your portfolio of like, this next year, I don't know what's going to happen. I'm going to limit my risk for the time frame of the ETF itself. Sometimes that can be kind of a handy way of setting a horizon for your investment with these, if you are somewhat temporary about using them.
Right, that totally makes sense. Yeah, so I guess like I have, I don't want to get like too complex. You say that like the defined outcome ETF is built from options, and I was doing
Yes.
a little bit of my own research, and I noticed that like we have different style options, which I think we've also had that on our podcast list to do some option stuff. But it seems like in being defined, it's like and using these options to like sort of create a buffer and create a cap. We're getting very close to the underlying asset. You want to speak a little bit about how close do you expect to be, and what is that what is that time horizon? And like these defined ETFs sometimes have like reset days or reset periods, and like do you tell us a little bit about that? I guess if that's possible.
Yeah, I mean the best is probably a 1-year time horizon for in terms of what these are constructed to be, like that time dimension that I mentioned. And usually when they are trying to create the returns of the market, I mean, they're kind of figuring that it will converge, not completely replicate over the course of a whole year. And a lot of the kind of volatility that you may not always be matching the market itself will be smoothed out in the long run. And that's generally what I've seen happen. Usually it's mostly the downside volatility that gets kind of weird with it's usually a lot less in monitoring them day to day. In my own experience, I say, well, it's just not going down as fast, and that is somewhat related, I guess, to the kind of person who owns these, and there's a lot at work there, but they are aiming for a year time horizon most of the time. The ones that are in annuities sometimes are much longer. The longest I've seen in recent time is a 5-year time horizon. And so then you're, as an investor, thinking, okay, by the time 5 years is up, my returns really should look more or less identical without dividends to the index itself. And dividends themselves play a big disruptive force in kind of the flow of the price movement, because this is another complaint I have with the defined outcome products is they don't include dividends. That makes them good in some ways and not so good in other ways.
You like dividends, I know this much.
I know. Yeah, the irony of somebody who really has done so much work with dividends as I have, speaking even somewhat positively of defined outcome, is, somebody will note that, I'm sure. It's definitely there. And so, dividends being absent from these create some disruptions, because dividends are a major part in the day-to-day pricing of indices.
So when you're thinking about building a portfolio and using these defined outcome ETFs, are you thinking about using it to replace part of the risk in the portfolio, or are you thinking about it as a separate stream, since it is supposedly reflecting some of the indexes you might already be invested in.
Well, yeah, usually I'm looking, I tend to recommend the ones on the more obscure indexes a little more often than just the S&P 500.
Totally.
So that would be the small cap Russell index. Small caps, now their standard deviation is kind of nauseating for most investors. It's 34%. On average. So up or down 34% is within the statistical norm, which is, for many people, disturbing. So they can't really deal with that.
So it depends a lot on what what our risk tolerances are and how far out we are trying to invest, right? I mean, obviously, if I'm coming to you and I'm saying, look, I have this amount of capital, and in 2 years, I don't know, I want to retire, buy a business or something. You're probably not going to be like, hey, why don't you put your money in this?
In small caps? No. Small caps, but sometimes people have never invested in small caps before, and so it can be kind of a good introduction to investing in small caps. And also, some people, small caps, in the very long run of things, outperform large companies. So it's just
right.
a statistical anomaly we've known about for a really long time, almost 40 years.
It's part of the nature of small caps, right? Yeah, it's kind of like how I remember there was this bond trader, right? He was saying, look, if you want to make money, you got to trade junk bonds.
I know.
If you trade investment grade bonds, they already are doing as well as they're ever going to do.
Yeah.
You can only do worse, right?
Yes.
So I always thought that was funny, yeah.
In small caps, they have marginal utility, which is a great economics concept on their side, whereas many very large companies have that against them to a sometimes extreme degree. So they have that, but it's also an anomaly. That's the right word. It's not just kind of an obscurant economics jargon word. The small size anomaly comes from the fact that we can't actually consistently describe why it happens. Nobody's ever in the 40 years that we've known about this been able to conclusively say this is why that happens. So it's still called the small size anomaly.
I think it's because Americans and investors like diversity. So they're out there investing, supporting these, even though when we say small cap, people should know this is not a small business.
Yeah, well,
I like cap is not a micro.
I always say Wall Street small.
Exactly.
When I explain this is not a Chaim Investment Advisors level. Yeah. This is
no one here would be upset about having the amount of capital that a small cap business has. That's
this is more like,
in fact, nowhere in the world would they be upset about that. Not even Warren Buffett or Jeff Bezos be upset about adding that to their portfolio. So there's a lot of money when you say. So I mean, actually, that's good though, because just sort of like in a off topic from the defined outcome ETFs, it shows how much capital there is out there and how much opportunity there is out there and potential there is out there. So
yeah. Well, and sometimes people need that. They need that moving piece to the portfolio, and they can't really deal with what is normal in the small cap space. And that makes sense. In large caps, you say, look, even, the standard deviation being what it is, it's probably okay for most people. Small caps, even myself, you just have to not look at them a lot of the time. I'm going
to tell you honestly, Chaim, I'm like the guy who likes to stare into the sun, so I'm going to be looking at defined outcome every day.
There are also people like myself. I get stressed out when things go up too much really fast. There are those people. So it's not just stressful because it goes down. It also can be stressful to see it go really stratospheric.
Sometimes you text me this, and I don't understand. I'm not like, I don't have the sophistication yet as an investor. I'm like, it seems like good to me. It's going in the right direction.
Yeah.
But there is a sophistication level there. So I appreciate that. So that seems like a lot of good reasons to use this defined outcome. What do you think?
Yeah.
Like, just could you give us like, I know like we don't want to give like specific investment advice because we don't have specific information. But what kind of like where would you see this really like this for? Like you already said like, hey, I'm trying to find sort of alternative streams of income, which is great for diversification. I'm trying to be less exposed to small cap standard deviations in the market. Where else would you think this is like really useful? Or someone might really benefit from this?
I mean, the number one group is definitely transitional retirees. Transitional retirees are the most conservative kind of as a basket, and it makes total sense. You have no idea what your life's going to look like a few years from now. You've spent all your time accumulating, and now you're looking at decumulating. That is, kind of terrifying for a lot of people. And a lot of times you kind of have a mark that you want to hit, a milestone by the time you're actually fully 100% retired. And so defined outcome is really useful for people kind of with a lot of upheaval. Maybe they're buying a new house to downsize and trying to sell their old house. And so it kind of shakes out that they'll be okay, but there's usually a few choppy years into transitional retiree phase, except for the most wealthy. And another part of that is Social Security. When you're at full Social Security benefits, that kind of takes a lot of the heat off, even for upper middle class earners, which actually really does help a great deal to stabilize things. In that phase between like 58 and 66, though, there's a lot that can happen.
Are we looking then at like sort of target returns for portfolios? But once we hit that target or we want to retire, or do you think like that's a point where we get more into bonds and we're looking for more like fixed income, like rather than defined outcome? Right.
And the kind of fixed income you have as what you might call a mature retiree, somebody who's fully retired, looks totally different from somebody who is using fixed income for total return. Because now you're like taking it and buying hamburgers and paying your mortgage, or who knows what you're doing. You have your travel budget.
Traveling.
Yeah, you've got your travel budget, your golf budget.
If I did okay, and then I'm in my coach if I did really, really well, And then, I'm just traveling around. I always like that movie Chef, because he's got. Have you ever seen that film?
Yes.
Have you seen that? It's really good. Yeah. So I'm doing that, except I'm not selling anything. I'm just going out.
Well, so you don't. You avoid the negative series of returns that I just mentioned earlier if you are getting more current income, because you're not banking on selling things at a defined price. Now,
right.
Defined outcome ETF, much more useful if you are kind of trying to sell something in a range. It's actually, much more useful because you're saying, well, I am looking to make X amount and Y amount is really the most negative that I can deal with to draw what I need to out of my account. And there's other ways of dealing with that. I mean, maybe you want a defined outcome annuity at that point of your, if you're really in that place, maybe other products actually make more sense, but these, no reason that they can't work in tandem with that strategy too, to give you some upside, but make it so that you kind of have a more reliable flow in the portfolio.
Yeah, that makes total sense. So I think I have a better understanding of why we would use these defined outcome ETFs, especially what the upside is, literally and figuratively. And I think definitely I think we talked about this before. It'd be really cool to do a sort of a second podcast on defined outcomes that really explores the technical side for those interested. So we'll probably do that, right? And we'll actually prelude that. Is it the right word? I might have made up that word. But beforehand, we'll do a podcast on options, because that's really important to understand defined outcomes, and really important for just general investment knowledge, But yeah, I think that seems like a great introduction to me. You answered all of my questions, so I'm a little annoyed. I gotta have more questions next time. I'm trying to stop.
Well, some of the most technical stuff, even I will call up the people who make these. Although I did get to do my first product consulting gig a couple of weeks ago about this exact topic with
Awesome.
somebody looking to make a new one, and wanted my kind of input on, as an advisor who uses these, what are you looking for? Which is great, because then I knew that they were going to listen to me, because sometimes I call defined out, some defined outcome providers, and they go, yeah, wouldn't that be great? I mean, we're only doing awesome. This for billions and billions of dollars. But yeah, sure, Chaim.
Yeah. I hope it goes well. I mean, their product, because they probably got at least two people's input, so that's good.
Yeah, it looked okay. It was a pretty okay product that I might recommend if they ever complete it and bring it to market.
Actually, that's awesome. Okay. Yeah, that really answers my questions. I don't know. Is there anything you want to add to?
What I want to add to this is that don't think that you have to own them forever. That's one of the main things that people should not get into with these. They can be very temporary. There's nothing wrong with having these for a year and saying, you know what, I'm ready to take on a little bit more risk. A lot of the people listening to this, they're kind of in the middle, maybe upper middle class, people who year to year kind of have a variable amount of money that they have. They have a lot of financial goals. This is actually another great point about defined outcome and how I would use them. Your only goal in life, for most people, is not just retirement. Most people have half a dozen or more financial goals that are not happening at age 65. They're happening at age 39. They're buying a new car. They are looking to adopt a kid. This is one that I see fairly often. They're looking to make a big purchase for fun. Maybe they are shooting for a goal for a really nice boat for the family or something, and it's going to take a while. Defined outcome actually can work really well in those circumstances as well, where you've got a timeline. You say, yeah, I can deal with some amount of variance, but not very much.
Right. That makes sense.
Yeah, so there's your timeline with the ETFs in the defined outcome space. It's pretty open-ended. You don't have to think, well, I bought this thing, now I own it forever. It's not really that way. It's just like any other ETF. You can say, well, next year, moving on to a new strategy. And so they can be really useful, for a kind of placeholder-ish type of moves with your portfolio, which is, another circumstance that I tend to maybe use them for.
Totally.
Yeah.
I think that makes sense. Yeah. Like I said, I was kind of trying to do a brief introduction, and I think I wish I had more questions really, but all of my questions actually are these technical questions, and we kind of discussed this beforehand, and we were like, we got to talk about options before we just unload.
I know
people about these are flex options and European style options, and
yes,
how you can exercise them in the strike price and outside the strike price. So we do have a lot of content actually probably coming for this defined outcome, but we kind of have to wait until we talk about options. Which so also if I sound hesitant, it's probably because I want to ask these questions, and Victor's don't ask those questions, Pablo. You're going to make this podcast podcast with
Well, and there's probably some people who are listening to this saying, well, I'm really interested. I want to know a lot more. Some of those people will reach out and talk to them next week when this comes out. And then there's some people who say, well, I want to wait and learn some more about it. And they want to get a lot more in depth. And some people will listen to this and say, wow, that's not for me, man. Which
Talk
is
more
fine.
about hotels. We like
Look, these are not the most thrilling investment in the world, I will admit. And some people are thrill seekers with their portfolio, and this is not for you, man.
we do try to have a variety on our podcast. Like I said, we probably have 15 podcasts lined up, and we've just been trying to get into this routine of we don't want to release them every week, and then we don't release one for a week. So we're trying to release one every 2 weeks, trying to get this routine. We do have a variety. We try to keep some that are fun, but every once in a while, I think it's important, and Chaim thinks it's important. Also, we are educating you guys as investors, just making you more knowledgeable, so you feel like there's a transparency and you just can make better informed decisions. So yeah, exactly. I mean, personally, I think it's exciting, and I especially think that the technical side of it is exciting. But it's not going to be exciting to everyone, because if you found it exciting, you probably would be an investor. So you probably would be I do this for a living, I'm an investment advisor. So.
But the point of what I was saying there is that there will be some people, they'll say, man, I don't need a second episode. I already know I don't want to deal with these. And so we'll do another couple related episodes, because there's much more to talk about with these. And also there's talking about, well, if you are using them, how do you mitigate some of the negative impacts? I have a lot of thoughts on that. That's probably for another day as well, because that's for people who probably already are using them or are really thinking that it's for them. That's a whole other ballgame.
For those of you who are this is not exciting, we have a podcast coming up on trader movies, which should be interesting. And we also have another podcast coming up, which is sort of similar to our Halloween theme, which is just except it's specifically for trading and investing, sort of not necessarily nightmare trades, but just these really fluke anomaly, sort of really famous trades that have happened where obviously it's a zero-sum game often when you're trading, and one side got the better of the other side. So we would have some of those coming.
Yeah, we'll have always have a balance of fun stuff and more technical stuff. And I assume probably a lot of people will tune in for this one, though, because
I hope so. I think it's actually we didn't get too technical, and I think it's a really valuable product. So.
Yeah, and I recommend these often enough that people will want a little bit more behind the scenes discussion than sometimes I get to. So this has been great, and we'll do verse 2 next time.
Excellent. You guys have a good week.
Yes.